Hello, everyone, and welcome back to another episode of Multifamily with the one and only super fashionable, as always, Veena Jetti.
Thank you for having me.
And today we're going to talk about money. So when it comes to all your different assets, you want to make sure that they're all doing well. So we know that you have a huge portfolio. Yes. How do you go about handling all of those assets?
Yeah, very carefully with a lot of systems and processes and checks and balances. So we have a third-party property manager on most of our assets, which means that they're managing kind of the day-to-day, right? We handle asset management. So on the asset side, we're managing the managers, if you will.
Oh, wow.
So I'm not necessarily answering a phone call because someone has like a leaky faucet in unit 102, right? I know how much we're spending on plumbing in a month or repairs and maintenance in a month from our reporting and our budgets, et cetera. But I'm not walking the property day to day. We have a team who does that, and we have an asset management team who's overseeing that. So we're pretty hands-on about managing our assets. We like to intervene early if there's an issue. So from the time we go into an asset to the time we exit, we are looking at on a weekly basis, a monthly basis, a quarterly basis, and an annual basis. And we're measuring the KPIs and we're measuring our returns and our performance metrics against where we budgeted or where we thought it would be compared to where it actually is.
Right, pretty much to see how close to you guys' goals are on each of
exactly.
the assets.
Yes.
Now, I know that for some of our viewers, they want to know if it's better to do it themselves or to have a property manager or someone else taking over those types of controls. So would you recommend someone that is starting to have someone else to do that for them?
I do think it's better to have someone who's experienced do it. But the reality is sometimes if you're going after smaller assets, especially, you can't really afford to have somebody on there. So if you can't afford it, you're going to have to figure out how to do it yourself. But if you can, I always think it's best to plan for it and to underwrite for property management. Asset management, so there's a difference between property management and asset management, right? Property management is you are managing the actual property, you're managing the day-to-day, the tenants, you're managing the day-to-day expenses, income,
rents,
all of that. Yeah,
right.
Rents, your, like I said, leaky faucets, leaky toilet, all of that.
That's right.
You're managing on the property management side. Now, if you're on the asset management side, you're managing the performance of the asset and the performance of the property managers. So you're managing the managers. You're not managing the leaky faucet. You're managing the budget that pays for the leaky faucet. You're managing the strategy behind the value add and the CapEx, et cetera. So there's a difference between the two. Asset management, I feel you always have to have in-house. Whether it's your team or you doing it, you need to manage the asset because, there's that saying, when the cat is away, the mice will play. And so you just want to make sure that your property managers are really staying on top of it and staying true to your vision, your business plan, your execution plan.
And also you mentioned that you want to see if the asset is performing the way that you expected it. I believe that there's also a pro forma that should give you a little bit of an idea. So what is it? What's a pro forma and why is it important to actually pay attention to it?
So a pro forma is essentially a metric we use to measure the possible outcomes of the property. So when you have a pro forma, what you are looking for is okay, this month we thought we were going to spend X amount on repairs and maintenance. This month we thought we were going to get X amount in rent. This month we thought we were going to get X amount in additional income. And so basically it's a way for you to track your performance. On the flip side of that, you're going to want to use what's called a T12. So your T12 is your trailing 12. It's the last 12 months of operation and it rolls. So every time there's a new month, the oldest month falls off of a T12. So what you're going to do is you're going to utilize the T12 to be able to tell you if you're hitting your pro forma numbers or not.
What are some of the other tools that you use to make sure that your assets are performing the way that you should?
Yeah, so we have in-house spreadsheets and performance metrics that we track. So we track, how much we're getting in rent compared to where we thought we'd be. We look at rent income from renovated to unrenovated units. We look at additional income on our assets. We look to see, are we tracking to where we thought we were going to be? And if we're not, why not? And how do we change that?
And what are some of the, because you mentioned that you have your spreadsheets, but in the case of somebody that is starting within multifamily, how can they create all of those tools for them to be able to track that?
Yeah, so I would create a spreadsheet from your pro forma, and I would say, okay, this is what you budgeted for. And then I would just add another column. This is so easy. I would just add another column next to it and say actuals. And then next to that, I would just have Excel calculate, okay, so you have budgeted, you have your actuals. What's the delta? Is it red or is it green, right? Are you overperforming or underperforming? For the case of the income side of your T12, you want to be making more money than you thought you were. And on the expense side, you want to be making or having less expenses than you thought you were going to. And so that's how you can really track. It's very simple. As you get more and more sophisticated and more involved, then you can start tracking with a little bit more complex systems.
How was your experience, though, when you started with your first deals? Because I feel like you didn't have those systems from the beginning.
No.
So how was that?
I wish I had these systems in the beginning. I wish I had gone through and set these things up in the beginning, because what it does is it allows me to be able to manage it more efficiently. Because now I can spot an asset that is not performing or that's on track to maybe veer a little bit. And so it's not on track. And so I want to be able to intervene on those assets as soon as possible. So at the very first possible sign that we're going to be missing pro forma expectations, I want to know about that so we can go in and we can recalibrate and adjust it so we can get back on track.
What are some of the mistakes that you had at the beginning of your career when you were looking at the performance of your buildings?
There's so many, so many. I think one of the biggest challenges that we have, and we still have this challenge today, I was just less confident in maybe addressing it, is when you have a property manager that's not the owner of the asset, they have a competing priority to you. So the way that they want to operate the building is they want to pay bills, which is fine. But for you as the asset manager and the sponsor or operator, you're trying to balance cash flow and investor returns. So while, of course, you want to pay your bills, you might wait 10 days to pay a bill that's net 10 days versus paying it right away just to knock it off the to-do list and make sure you're checking it off. You might wait so that you get a little bit more time so you can build up more cash flow before going and paying that.
Gotcha. And you also mentioned that there are quite a bit of metrics that you guys look at. I know that one of them should be the NOI. Can you explain us a little bit about it too?
Yeah, so NOI is essentially your net operating income. It is your total income minus your expenses that leaves you with your NOI. Now, NOI is important, but it should be noted that this doesn't include your debt service, which we call like your below the line number. Okay. And it doesn't include any manager fees, anything like that. And it shouldn't include your CapEx spend. So if it's a capital expenditure, it goes below the line, not above the line. So your NOI, think of that it's like on a profit and loss statement. It's your net profit, or I guess gross profit really, because your net profit would be after your debt service is paid and your CapEx.
You mentioned the CapEx. And what is the CapEx?
Okay, so CapEx is capital expenditures. That just means what kind of capital are we going to be spending on replacing or improving the asset. So as an example, if you're going to come in and you're like, hey, we're going to take this from red paint to white paint to update it with where the market is. We're going to put backsplash through the kitchen, stainless steel. All of those costs could be considered CapEx expenditures.
And when it comes to the performance of your assets, have you ever had any of your assets that didn't do as well as you thought, and how did you solve it?
Yeah, so in COVID, we had an asset that definitely struggled more than the others. I mean, investors still made money on it, but it definitely was a lower return expectation than we had projected. And so how we dealt with it really was we increased investor communication. We made sure that we were looking at the asset more often. We were tracking KPIs more often, but it really was a function of being thrust into COVID with a tenant base at that time who could not really afford it. And now we've since shifted our strategy to be in a little bit of a nicer tenant base so that it's not as much of a risk or a concern.
Right. And it all comes down also to your tenant, because the tenant is the one that you are targeting for generating or your income. If you have the right tenant, you should be safe during any sort of crisis or things like that could happen.
You're more insulated.
Right. Because they would have enough funds to actually keep going with the rent.
Exactly.
Now, I know that you mentioned that you have quite a bit of assets that you guys are handling within your properties. And when it comes to managing, you said asset management that you do for all of them. Can you tell us your experience on one of the assets that performed the best as of now?
Oh, yeah, we've had a few of those now. So one that we recently had, it recently exited, we basically almost 1.8x investor capital in 18 months.
Oh, wow.
So that was over a 50% return, 50. And, that was definitely a challenging asset to manage because the tenant base was a little bit, it's all relative, but it was a little bit on the harsher side, but the asset fundamentals were phenomenal. We acquired it during COVID, so no one was really buying. So we got really good pricing on it, and we were able to exit it at the right time to really make a strong return to our investors.
So out of all the markets that you invest on, which one is the one that you invest the most?
Yeah, so it's not even by design because we like all of our markets a lot, but we have been very heavily focused in Atlanta and the Research Triangle of North Carolina, both.
Mm-hmm. And how are the rates for vacancies there, the rents? How is that performing right there?
So both these areas have been performing phenomenally. They've been very strong, stable locations. Mm-hmm. We're seeing a lot of new rent growth. We're seeing a lot of influx of new tenants into the area. There's a lot of job growth, a lot of diversity in the job sector. And both of these markets have seen amazing rent increases. When we go in and we renovate, we are able to really bring the rents up and make a solid return for our investors. Sometimes we're seeing as high as like 18 to 25% on rent increases. Oh, wow. Yeah.
That is really incredible.
Significant. And, we're not even pushing it above market. We're just pushing it in line with the market.
Mm-hmm. It's pretty much bringing up to date all of those buildings that you guys are acquiring.
Exactly.
And I feel like that's the key takeaway of this, that whenever you are looking at all of these multifamily buildings, you also need to look at the market that is around it.
Yes.
You want to make sure that you stay competitive.
Exactly. Because if you don't know what your comps are doing, what the other assets in the area are doing, how could you possibly know what you need to be doing there?
That's right. And I feel like that truly helps all of our beginner investors into multifamily. Because when you're starting the game, you don't know how much to expect your buildings to be performing at. But if you start looking at all the other ones, you should have a better idea.
Exactly. And, that's the other thing, too, is whether you want to be active or passive, you can sign up on other sponsors' lists. So you can sign up on lists of sponsors who are already doing this, and you can see what types of returns we're projecting, what kinds of assumptions we're making. So if you want to be passive, you can start seeing like, okay, who are the sponsors that their methodology, their business plan, their risk aligns with yours. And if you want to be a passive, that's if you want to be passive. If you want to be active, you can say like, okay, well, what is Veena doing? What are Veena's assets doing? What assumptions is Vive making? What assumptions is X person, Y person, Z person making? And then you'll start to see kind of trends in the markets that we're in.
That's true. Thank you so much again, Veena. And thank you to our audience. So there you have it. Look at the competitors. Try to stay competitive when you have your multifamily buildings. That way you can get the tenants that you want and the income that you desire. Thank you so much. And we're going to see you in the next episode. Bye-bye.